Hey everybody, Economic Ninja here. I hope you're doing good. Let's wake up, everybody. This is an awesome day. Why? Is because the Federal Reserve is giving you a lot of clues, and so is the market, of what's happening, what's going on behind the scenes. Are we going to raise rates? Yes, we are. Are we going to have to slam rates down because we're going to crash because of it soon? Yes, we are. And we're going to get into that, okay? Now, guys, this is an article obviously out of the hedge. Look all around me. The article's all around me. We're going to link that in the description below, but we're going to go over it, give a little bit of commentary, and give some ideas. And guys, I want everyone to remember right now, if people get stressed, be like, oh, the market's going to crash, there's no way it can hold up. You're right. You are 100% right. But this is actually a good thing. Why? Because when you see trouble on the horizon, you do something about it. If you are on railroad tracks and the train is coming at you and you don't want to die, you literally just, hey, I'm still alive over here. I'm going to let the train go by. That's literally all you have to do. It's so awesome. And so when we see problems like this, it's not like I'm telling you to sell all your stocks, sell everything. This isn't financial advice. I'm not a financial advisor. I'm just a dude with a brohawk and a dream. And that dream is to be able to lead an amazing amount of human beings, an army, if you will, of people that are ready to get out of the system, bank yourself, become your own central bank using things like gold, silver, cryptocurrencies, good things. But I mean, who am I to tell you what to buy? I'm just a dude with a brohawk and a dream. But that is my dream, because I believe that we are going to amass the greatest amount of wealth in recent history because of the greatest financial collapse in recent history. So I believe this is quite a good time to be alive. So FOMC minutes show Fed to rush rate hikes, leaves QT details quantitative tightening, up in the air. All right. Quantitative tightening. Let's talk about that first. There's a lot of things the Federal Reserve is doing to juice the markets. They've got the orange and they're just squeezing it, and they're trying to make as much orange juice as they can because all the peasants are like, we need more orange juice. And they want to enjoy the orange juice, right? And they're like, well, these oranges are getting expensive because the CPI is not lying anymore. It is still lying, let's be honest. But inflation is really starting to move up and people are starting to get concerned. So the Fed has been trying to juice the markets for literally ever since the great financial crisis, and they are having a hard time backing off. They started to taper the amount of help they were giving the markets by the amount of assets they were purchasing in January, and we saw an absolute bloodbath. And I'd say it's a bloodbath because some people are like, Ninja, the S&P wasn't down that much. It's not a bloodbath. It actually was, because it was the same percentage loss in the markets in January as you saw in January of 2009, and that was coming off of the great Lehman Brothers collapse, okay? So I do believe that's blood in the streets, and yes, I do believe it's going to get worse. When? Have no clue. You're going to need like a magic 8-ball or something for that. So it says here, since January 26th, the FOMC meeting, bonds have been in a bloodbath. Whoa, wait a minute. Somebody else just said the same word. While stocks and gold are higher and the dollar is flat. That is correct. We've been talking about gold and silver, even though it has not moved in the way most people think it should. Just the same exact thing happened in 1979. People are like, why isn't gold moving up? It was, but not that breakneck pace. Get ready. It's a coming. It says right here, we've also seen a dramatic rise in rate hike odds in the period since the last FOMC meeting. With a 60% chance of a 50 basis point hike in March priced in. And I do actually believe they're going to go 50 basis points now because things are getting pretty dire. And we just saw the wholesale numbers, the PPI numbers come out and just completely blew away Wall Street expectations by double. So that's pretty exciting because that means next month you're going to see the CPI rise pretty well too. It says, and the liftoff trajectory of rate hikes soared. The yield curve has collapsed, signaling growing market fears that the Fed is on a path to policy error. And when they talk about the yield curve inverting, guys, remember the 2-year bond is moving up so sharply. I want to say it's up 110% in the last 90 days, maybe even less than that. And that means that investors are scared. They do not want to keep their money in anything long term, so they're keeping it in short term treasuries like the 2-year. That's what's causing it to go up. And yeah, it's pretty amazing. As a matter of fact, I don't know if you know, a little sidebar, Japan did a bond offering and they had like no buyers just the other day. Like, whew, that's bad. Now this is why we're here, guys. If you made it this long, do me a favor, hashtag March Madness and also hashtag Rate Madness in the description below. So I know you've been watching it and it has to do with this. Perhaps most notable is the fact the forward curve has moved rapidly to price in rate cuts starting in 2023. Do you know what that means, guys? That means there are a lot of smart people out there that believe that, yeah, in 2023, by 2023, everything's going to come falling down, and you're going to, those little bullets you put in the magazine, rate hike, that jammed. Now let's start firing those things off because we got to go rate decrease. And I think they're only going to have 2. I know you're going to come back to me in June and go, oh my gosh, the ninja may have been right. I think we're only going to see 2 rate hikes, honestly, before this goes. How much, we don't know. Is it going to be 50 basis points and probably another 50 basis points? It could be. But I can't see this really going past, for sure, 1.5%. But 1% is going to put a lot of strain on the economy, especially the government. The government's going to have a hard time running because it runs off of debt. Remember, it doesn't bring in enough taxes. Even though it feels like you're being completely pillaged, which you are, the government needs more pillaging, and they're having a hard time doing it, so they have to borrow more money. So this is literally why I wanted to do this video. You are seeing people on Wall Street go, yeah, they're going to cut rates in 2023. This is going to be impressive, guys. Something else, I just wanted to go over a couple things. So with that said, today's release of the Fed minutes are somewhat moot. Go figure. They're scared to death. They don't want to tell you guys the truth. Given all the post-FOMC Fed speak, but all eyes will be on signaling around 50 basis point hike. So that's a 0.5 percentage point, okay? Because right now we're at 0. Fed funds rate is at 0. We're looking to bring it up the 50 basis points and bring it up to 0.5%. And any comments on the terminal rate, anyone on the Fed expects. Okay, wait, so here's a couple things. On policy, in light of elevated inflation pressures and the strong labor market, man, guys, I'm going to stop there. I have a feeling now the strong labor market means there's lots of job openings, but it doesn't mean it's strong because those openings are actually getting filled. There's lots of openings, but there's not people filling them, all right? And just a little sidebar too to that, there's a lot of people say, Ninja, I don't know what you're talking about, I can't get a job. You're probably looking in the wrong place, and you're also probably looking in the wrong field. Because I can tell you right now, if you wanted to move into the trades like carpentry, welding, things like that, there's going to be, even though we're seeing, a depression on the rise, on the horizon, there's still very few people out there replacing those jobs from men and women that have just recently retired, not only through age, the baby boomers, but people just said, the heck with it, I just give up. So there's a lot of really great jobs that pay well, even if you don't want to go to college. So it says, in light of elevated inflation pressures and the strong labor market, participants continue to judge that the committee's net asset purchases should be concluded soon. So that means they're going to really try and slow down quantitative tightening, or get it finished, actually tighten to where there's no more, juicing the markets. I don't believe they're going to be able to do that. I believe if they start to rapidly slow that quantitative easing down, you are going to see more blood in the streets. All right, guys? So I wanted to bring you this information because really, again, it is all about this right here. The market is starting to price in rate. We're at 0% Fed funds rate. They are already starting to price in rate drops in 2023 to 2024. That tells you a lot. Not only is the fear in the market that, hey, I'm afraid that the market's going to crash this year, so we're not getting into anything long term. So we're going to short term treasuries, but also we're pricing in rate drops. So a lot of people don't think that the Fed's going to be able to pull this off, guys. So with that being said, I hope you got something out of this. Guys, again, let's clarify something. Gold and silver have not made their moves yet. Will they someday? Yes, they will. Do I know? Absolutely not. Timing is the one thing that no one will ever get perfect, okay? But you have to look at the seasons you're in, okay? Those are the 2 asset classes right now, or 1 asset class, 2 materials that have literally not exploded in value compared to other things in its class. You are going to see people more and more weary of central banks, and banks in particular, because right now banks are starting to freeze accounts, banks are closing. There's such a myriad of reasons, right, to be your own central bank. Have some cash on the side. Have some precious metals. I'm going to put a link, actually. There's a deal right now on silver buffaloes I found for $3.19 over spot per coin. Silver is what, at like 23 and change right now. So right now you can still pick yourself up a silver coin for, X amount of dollars. Some companies have shipping, some don't. Sorry, I digress. The point being is this. People ask, where do I start? And I'd say you start at home. You start by actually owning something. Don't get into more debt, guys. Get out of debt if you can. My biggest thing is do not speculate right now in these markets. And I'm telling you what, there's a lot of people speculating. I'm going to pull out debt to go and try and buy an inflation hedge. That will probably always screw you up really bad, because the market can stay irrational longer than you can stay solvent. So remember that. Do not take big risks right now. These are not the times for big risks. Those times have already passed. I mean, the day that you would have never thought a couple years ago that you could buy a car and then sell it as a used car a couple years later for more than you paid for it new. Think about that, guys. Think about the disruption right now that's happening in the world, the economy, the supply chain. And guys, just in the spring, it's going to get worse, because as winter turns into spring and people try it right now, mask mandates and all that stuff are coming down. People are going to try it again, just like last year, get back into normal, and it is going to logjam that supply chain up. All right, guys, that being said, I thank you so much for watching. The Economic Ninja is out.